Have you heard about the Bitcoin ETFs being approved in the US? Wondering what an ETF is? Maybe you're wondering what this means and why it matters. ETFs are a casual way for investors to own something without having to actually own it themselves. Bitcoin ETFs have existed in Canada for years, but the US is a much bigger market, and the opportunity to invest in Bitcoin in the US in this way is new as of January. As of January 10th, most of the largest asset managers in the world are offering Bitcoin ETFs to their customers. You're listening to the Blockrewards, the show where we help you understand Bitcoin without having to be obsessed with it. I'm Scott Deedles, I'm the founder and CEO of Blockrewards. Part of our mission in bringing Bitcoin to the workplace is helping people understand how it will help them. So if you're interested to learn more about ETFs and what the Bitcoin ETFs mean for Bitcoin and for investing in general, then stick around because we're about to dive into it. Our guest this week is Mike Willis. Mike has 25 years working in Wall Street, and currently he is the CEO, co-founder, and lead portfolio manager for CYBER HORNET ETFs, which are a newly launched and innovative solution to mainstream investing in Bitcoin. Mike's an expert on exchange-traded funds, and he has a great way of explaining them in a way that will make sense for you as a listener, regardless of your background in financial markets. Most importantly, Mike is passionate about Bitcoin and his mission to help mainstream investors understand it and think about how to include it in their own financial plans. He's a good friend of mine and somebody who I learn a lot from every time I talk to him. I hope you enjoy. All right, welcome to another episode of the Blockrewards podcast. Very special episode today. It is January 11th. We're recording this, and just yesterday, the SEC has approved all of the applications for spot Bitcoin exchange-traded funds. So in today's episode, we're going to be doing a deep dive with an expert on the subject, Mike Willis. Mike, welcome to the Blockrewards.
Thank you, Scott. Great to be here. Historic day. The new financial superstructure changing on Wall Street. So super exciting day. Thank you for having me.
Yeah, it's huge. And you guys are playing a very important role and a very exciting role in this. And we're going to talk a little bit about that later in the show. But before we get into it, why don't you tell our listeners a little bit about yourself?
Well, I traded my way through grad school. Got my MBA in finance, spent the last 30 years in Wall Street related positions and worked for Barney, Paine Webber, a lot of the wirehouses, started my own registered investment advisor, then started my own registered investment company, which is a mutual fund company. Traded as an alpha manager, which means we try to beat the S&P 500, and realized about 10 years ago that the S&P 500 is unbeatable in general. And over long periods of time, it's why Warren Buffett has an open standing $1 million bet to any hedge fund over a 10-year period. And that's the key part. We beat the S&P 500, I think, 7 years before it started to beat us and then crush us. So we got excited about the whole index space 10 years ago, went out and got the index ticker symbol, and then started getting excited about the digital space with Bitcoin about 5 years ago. And we can go into that in a minute. But right now, where we set is we're launching a set of CYBER HORNET ETFs that are Bitcoin related. And so we've stayed on Wall Street. Our goal is to try to bridge Wall Street to Bitcoin. And our heart is with the Bitcoin community. However, we are in a unique position where we know the compliance side, we know the SEC side of Wall Street. And so we've opted to stay on at Wall Street for this transition period and see if we can get 10 million Bitcoiners through the Wall Street distribution channel of ETFs. So historic day. Thank you for picking today for the day to do this because we're pretty excited over here.
So before we get into talking about ETFs and the ETF market, I'm just going to start with asking the same question I ask every week to start it. Tell me, to you, Mike, what is Bitcoin?
Oh, yeah, that's an easy one. Bitcoin is freedom money. You know, Bitcoin is better engineered currency than anything else that's on the market right now. It's the first citizen-sponsored currency in a millennia, or how, you know, I don't think we know our true history, but at least in memory, in recorded history, you know, there hasn't been anything like this, and so it's super exciting. We started out with shells and rocks with money, and then we went to gold and silver. We went to paper fiat system. And we're in the digital era, so Bitcoin is digital money, and this evolution was inevitable. The exciting part is how this came about with Satoshi Nakamoto, and the Immaculate Conception is, epic. And it was life-changing for me as I studied money my whole life. And all of a sudden, this gift comes onto the market. And for us, at a minimum, Bitcoin is competition to the current government monopoly hold that they have on the money system. And that's exciting in and of itself.
Software eating money. What was your orange pill story? How did you discover Bitcoin?
Okay, so because I've been a trader for 30 years, as soon as Bitcoin hit the market, literally in 2009, I had it as an open screen on one of my 3 screens that I traded with from day one, just because it was interesting, it was new, and I wanted to watch it. So I saw it go from 1 to 50, 50 to 100, 100 to 300, back down. I watched it break through 1,000. I never bought it because growing up on Wall Street, you get brainwashed to traditional asset allocation. You get brainwashed to the financial system. And so there was a lot of negative Bitcoin press in the Wall Street community from the beginning. And that didn't keep me away from it. But my thinking at the time was, if a coder could create a Bitcoin, then another coder could counterfeit it. And that was just my logic. So I sat there and I watched Bitcoin run, for years, 10 years. I mean, maybe it was 8 years before I finally came in. But I decided to do my rabbit hole dive, that 100 hours you have to give Bitcoin, to really see it. And when I did, the cryptography was so impressive that means Bitcoin just dropped, by the way, is that the cryptography is so amazing that you begin to see how this is different from anything else that's ever hit the market. And I kicked myself for missing that first decade of Bitcoin and the movement there, because if I would have taken the time to study it back then, I would have reached the same conclusion. So it's exciting. I think there's levels of Bitcoin evolution in every investor's experience, and it typically goes, you get into digital, you get into Bitcoin, and then you start to see some of these other coins that are in the market that are faster or better for this and that, and so you start to take positions in them. But as you do this deep dive and you really start to look at what these other coins gave up to be, quote, better than Bitcoin, it takes time, but it took a couple of years, but realized that Bitcoin was unique in the digital space. And so ended up selling all of those coins, going back to Bitcoin as being the one investment that I hold in the digital world. So I think investors, Bitcoin, people go from Bitcoin curious to owning some Bitcoin to increasing their exposure, their weighting to Bitcoin to 10 or 20%. And then I think at some point, if you do the full rabbit hole deep dive, you become a Bitcoiner. And then beyond that is a Bitcoin maxi, and beyond that is religious, right? It's a religion. And there's this utopian state of Bitcoiners that is pretty cool. And I definitely have one of those top levels at this point.
Yeah, there's a hilarious ongoing meme right now that definitely applies to me. That's something like, if you even own a single chair, you're not bullish enough on Bitcoin. Like you haven't yet sold everything you own. I'm close. But I do still have a chair or two. So I guess I have some ways to go. It's funny you mentioned about the code, because it is true. Like people who haven't really looked closely at Bitcoin, want to believe that it's vaporware, but it's so sophisticated, and the math behind it as well. It's almost hard to imagine that a human being invented it or discovered it, created it. And yeah, there are people who even think that, Bitcoin could be some kind of like alien technology or who knows what. But it's quite something. The deeper down the rabbit hole you dive. Let's transition a little bit and talk about the exchange traded funds, ETFs. And so for our listeners who aren't Wall Street buffs to catch up, Maybe just give us a little bit of the 101 on what an exchange traded fund is.
You bet. So for the last 100 years, you had to go through a stockbroker on Wall Street to buy and sell stocks. There really wasn't the internet didn't exist initially, and so you couldn't just pull up companies and research them. You had to have your stockbroker do that. And so over the years, stockbrokers, had a lot of power in that regard. They were the source of information and even quotes. Then as the internet came on the scene, information, started becoming ubiquitous and people started doing their own research. But even before that, investors realized that they didn't want to assemble their 20 companies, or they didn't trust their stockbroker to assemble their portfolio of 40 companies. And so mutual funds came onto the scene. It was essentially a one ticker way to own a whole portfolio of that was managed by a professional, and you didn't have to know them personally. And these professional money managers were typically a higher level than your stockbroker. So it gave you access to Peter Lynch and Warren Buffett and people like that. And so in one ticker symbol, you could own 100 plus stocks of some alpha managers' best ideas. And so mutual funds, though, only trade once per day. So everyone at the end of the day gets what's called an NAV, a net asset value price. They're good long-term instruments, and they became very helpful to investors. A couple decades ago, though, SPY, first ETF to hit the market, happens to be an S&P 500 index fund. And it was the first exchange-traded fund which allowed you to list this mutual fund on an exchange like the New York Stock Exchange or Nasdaq. So it trades like a stock. And the main difference between an ETF and a mutual fund is that it trades all day long, still closes out with one NAV at the end of the day. But these traders during the day will trade it, like Goldman Sachs and Merrill Lynch will trade it. They'll make a bid and ask in your mutual fund, and then they'll rectify books with you, the mutual fund sponsor, the ETF sponsor, at the end of the day. So technically, they still only have one NAV, but investors are able to trade it all day long. And the benefit is that the ETF distribution system is unreal, because a lot of places you can buy ETFs for free. They're immediately listed. We listed on the Nasdaq a couple of weeks ago. We're on most platforms already with that ETF. That's unheard of with a mutual fund. You have to go to every individual platform, company, Robinhood or whoever, and sign a dealer agreement with them, negotiate a fee structure. And then a lot of times they charge you an arm and a leg to get listed on their platform. So ETFs are amazing from a distribution standpoint, because it's the most efficient distribution rails in the world, in my opinion. It's like listing on Nasdaq, an ETF on Nasdaq or the New York Stock Exchange is like getting your product into Target, Walmart, and every major chain, Costco, chain in America in one day. So that's what an ETF is.
And to maybe one more, it's a term we'll probably hear a few times over the course of the episode. So what is the S&P 500?
So the S&P 500, in the beginning, managers, you hired a manager, an alpha manager, alpha meaning they want to create alpha performance above and beyond the market. And so the idea is you're paying this manager to buy the winners and sell the losers, right? And Jack Bogle came out 30 years ago or so, or more, closer to 50 actually now, and with an S&P 500 index, which was the top 500 companies in America and the largest ones by market cap. And the idea was just to own the market, and an index traded with a math formula. The manager executes the math formula. The manager does not execute his or her own judgment. So the S&P 500 are 500 of the largest companies chosen by Standard & Poor's in one index. And as an asset manager, you just track the index. Standard & Poor's moves out about 2 to 4 positions a month inside the 500, and you just track that as an index asset manager. And they're cheaper the fees are lower on those models. And over time, over the last 20-year period, the S&P 500 index beat 94% of all managers in the large cap arena. So very effective. The fun part is they're cheap. They're cheaper than the actively managed, and they outperform. So a lot of people have become Bogleheads, Jack Bogle's last name Bogleheads, and excited about how the S&P 500 actually beats their brokers. And when we looked at the market, it took me 20 years to realize this, but the apex predator asset of Wall Street is the S&P 500 index. Just like in the digital space, we believe Bitcoin is the apex predator asset. We actually believe you don't need anything more than the S&P 500 index if you're trying to trade stocks on Wall Street. Conversely, we also believe you only need Bitcoin if you're trying to track the digital space for new digital coins. So the S&P 500 is kind of strategic in our minds because we don't think you have to be an expert to trade stocks on Wall Street. You're going to do better. Most investors would do better off just owning the S&P 500 and calling it a day. And we think they would beat most of their brokers if they did that.
Yeah, I'm one of the people who thinks you're right. And if you are, it's something that has potentially huge implications for a lot of people who manage money for a living. So let's zoom in a little bit and take a look at the specifics of these Bitcoin ETFs and help our listeners understand the significance of what it means. So we've talked about what an ETF is. So what is a Bitcoin ETF?
So 5 years ago, Bitcoin futures were allowed to trade through the Chicago Board of Exchange to what's called CME futures contracts. And Bitcoin futures, for the first time, anybody who was in Bitcoin can remember a run up that we had at the end of the year that year, right before Bitcoin was approved to trade on the Chicago Board of Exchange and Futures. And it hit $20,000 on that day, and then went into a bear cycle right after that. And people have a lot of comments on what they think really happened there. But essentially, Bitcoin futures have been trading on Wall Street for the last 5 years, 5 or 6 years, but Bitcoin spot ETFs have not. In other words, if you wanted to own the actual underlying commodity, in this case, a digital commodity, Bitcoin, those spot ETFs were not approved by the SEC to be listed on an exchange in the United States until yesterday. So today is actually the first day of trading for these spot Bitcoin ETFs. And the difference between a spot Bitcoin ETF and a futures-based, the futures is a security. Nobody can steal that thing and run away with it. There's some advantages to spot because you own the underlying Bitcoin, but you also have to custody the underlying Bitcoin. So these big financial institutions have to figure out a way to custody that Bitcoin asset. Just like if you had a gold ETF that was based on futures, you still track the price of gold, but you own the futures, a paper version of gold. Whereas a spot gold ETF, they're required to actually own the physical gold somewhere. And so they have to find a custodian for it, and they have to pay those custodian fees, and they have to protect that gold from being stolen.
So yeah, so it's like the difference between, say, so what an ETF manager does, I guess, is they take people's money and they buy Bitcoin with that money, and they get paid a small fee to do that. And what you're saying is, with that comes a responsibility, whether it's gold or Bitcoin, whatever the underlying asset is, that asset manager is responsible for actually owning the asset on behalf of the customers who are using it as an investment vehicle.
Yeah, and it's bigger than that too, Scott, because there's it's Bitcoin in a CUSIP, right? When you get Bitcoin inside of an ETF, it gets a CUSIP. What a CUSIP means is your account at Charles Schwab can now buy it. You don't have to figure out what a digital wallet is. Up until now, you had to go figure out what a digital wallet is. You had to start learning about public and private keys. It sounds great to have a Swiss bank account in your pocket, and you don't need a bank in between you and your money, because I'm a proponent of a bankless nation. But there is no 800 number to call if you send your Bitcoin to the wrong address. And I think when you look at Wall Street, let's just say there's $100 trillion on Wall Street. Two $2 trillion came over to the crypto world. About 2% of Wall Street were first adopters, first movers into the space. But the vast majority of traditional investors have stayed on Wall Street, 98%, or even if you just want to call it 95%, but it's closer to 98% have stayed there. So putting Bitcoin in a QSIP allows it to be accessed by in traditional accounts all over Wall Street, all over in all 50 states. And that's the key here is we just opened the funnel up to a very wide audience. And up until today, the first step into Bitcoin, in our opinion, was too wide. Most traditional investors aren't going to try to figure out a digital wallet. The scariness of figuring out public and private keys and trying to get to cold storage. These are all very advanced features for even hardcore Bitcoiners, let alone, your mom and dad or just somebody on Wall Street that has a Schwab account and wants to try to, put $100,000 in Bitcoin.
So owning Bitcoin has its pros and owning the ETF has its pros. Maybe just give us your take on what are the benefits of actually owning Bitcoin yourself, and what would be the alternative benefits of choosing to own the ETF instead?
So I think you walk down this path of purity, right? And I think the pure play here is to own Bitcoin in cold storage. That's your pure play, because Bitcoin was designed to be decentralized money. You don't need a bank. Don't trust a middleman. It's trustless money, which is amazing. It's decentralized. You don't need a centralized exchange or a centralized bank to transact the Bitcoin on your behalf. The whole point of it is you want to create a trustless form of currency that's decentralized. So it's not centralized. So the pure play is to figure out how to own your own Bitcoin, and not even in a digital wallet, in a cold storage venue. And I think that's the ultimate objective here. However, now let's walk back from the pure play. It is much, much easier not to hold your Bitcoin in cold storage. I have to say, I still, as much of a Bitcoiner as I am, I just bought some Bitcoin on Coinbase, and I didn't move it to cold storage immediately. So their practicality here is that, and I know a lot of Bitcoiners and some big names that are on podcasts all the time, they still have their coins on exchanges. And so then you take a step further toward, just traditional investors. Your traditional investors don't even want to try to figure out how to open an account on Coinbase because they're already at Schwab or Merrill or wherever they're at. So now, if they can have access to Bitcoin through their Schwab account, that's how it's going to happen. That's how the wide adoption, we think the mass retail adoption of Bitcoin will only happen through the ETF superstructure, which as of today is just started. The Bitcoin era on Wall Street literally starts today. And so it's exciting, so where you are in that scale, if you're fine just holding it in an ETF and letting somebody else worry about custodying those assets on your behalf, but you get to keep it in your same traditional brokerage account, well, then the ETFs are for you. As you get more educated and you're like, I'm not, I'd rather have a little bit more control over my keys, my public and private keys, then you can start to move down that scale to more of the purity side of what Bitcoin was originally designed for. But in our minds, what's exciting about this is every investor that owns a Bitcoin ETF, no matter how it's structured, it can be futures or spot. If Bitcoin's up 40%, if they're up 40% in their ETF, and some congressman comes out with a bill to limit the use of Bitcoin in America, you've got a Bitcoin advocate, you've got a Bitcoin voter in that investor, because he's like, what are you talking about? So for us, the fastest path, Corey Clipston said that, win the race to adoption to avoid the war. He wrote that a while back and came up with an idea that you needed 10 million Bitcoiners to really tip the scale. And we think ETFs are the only way you can get to that 10 million Bitcoiners, but before legislation starts to restrict and outlaw Bitcoin, because the US dollar is the global reserve currency, and the status quo is uncomfortable, let's just say, with having a competitor in the market that threatens their government money monopoly. And so the faster we get retail adoption in our minds and our views, the better.
It's one really interesting development that's happened with the approval of the ETFs is companies advertising their ETF products. And I saw one this morning. One of the ETFs is from a company called Van Eck. And in their ad, they have explicitly said that something, I might not get it exactly right, but it was basically Bitcoin might help you protect yourself from governments debasing the currency. Yeah, it's really interesting. It's going to be a very interesting era, and I do think that ETFs, like you said, potentially, in addition to building advocacy, are a great way to expose a lot of people to just the general ideas and take it mainstream. There's an important distinction, I think, that might be worth talking about, and with some ETFs, where the underlying asset is a commodity, customers are able to redeem the units for the actual thing. So this is true for some gold ETFs, where if you own the ETF, you want to cash it in, you have kind of the optionality to take it in cash or actually claim the physical gold. Now, the ETFs that have been approved in the US are so far different, right? And my understanding is that they are all only to be redeemed for cash. Can you talk a little bit about that?
Yeah, I haven't read all the prospectuses, but I did see Max Kaiser's comment on that on Twitter a while back, and I'm sure it's correct. I'm guessing it is correct for all the prospectuses, and I think that is interesting because as we move forward, I would like to see that changed. I'm guessing that was an SEC thing that was part of the agreement to get these into ETFs, because it'd be very cool to be able to redeem pay your dividends in Bitcoin or redeem your shares in Bitcoin. That would be a very cool feature. And if we can get to that, we'll definitely work on that with our ETFs. So I think it's there though, because, it protects the status quo and it creates a taxable event. I think there's a lot to unpack with that little clause that's in the prospectus. So, we were talking to Caitlin Long's camp, Lisa Howe, about how their bank that's chartered in Wyoming can custody Bitcoin a little more in the name of the underlying investor, and how it's separate from the bank, and it's held actually in a Wyoming trust structure that's in the individual shareholder's name instead of Coinbase or whoever, whatever the ETF company is. And we're looking at that, but the forcing you to sell your position, I think there's the current status quo works on taxes too, right? The IRS. And so it's not just a control issue, it's also a revenue model that I think exists, and I think that's part of that clause. What are your thoughts on why that clause got put in?
Yeah, I think you're exactly right. And it's, it would be cool if it's something that changed, but what I think it really does is it keeps the Bitcoin on Wall Street, and it restricts potentially a new avenue for people to buy Bitcoin or redeem Bitcoin, which just kind of adds maybe a layer of complexity that's not worth it for right now. Like my sense as an investor in a Bitcoiner is like, it's probably just more important to get these things into the market and get the general public sort of investing and understanding. And you mentioned Lisa, she's our guest next week, so that's pretty exciting. You can tune in for her. The other thing, what I'd love to ask you a little bit about is, so you mentioned SPY, the S&P 500 ETF has really, sort of been the star performer. Without naming, I guess they're all going to have sort of individual differences, but my sense is the Bitcoin ETFs have a very, very strong chance to be high-performing ETFs in terms of price appreciation. Like, what's your thought for what the Bitcoin ETFs could mean for the market share of the total investable assets on Wall Street?
So, in our opinion, the next 12 months, you're going to see more and more ETFs come to market that are innovative strategies, non 100% pure plays. So these spot Bitcoin ETFs are basically 100% Bitcoin plays. You get 100% of the upside, 100% of the downside. And I've managed money for 30 years, and I can tell you in my experience, if you're down 40% for an investor, they're burning up your phones. If you're down 50, they're out. If you're down 60 or 70, it's potential lawsuits. So financial advisors have not gotten excited about recommending to their clients, Bitcoin to their clients, because they realize the volatility of Bitcoin is beyond most of the risk tolerances of their investors, even if they are calling them on it. Because the numbers show that 20 to 30% of Americans are interested or have already bought and sold some Bitcoin. And they're doing it around their financial advisors right now because financial advisors traditionally have not been able to recommend it. Now that the Bitcoin spot, BlackRock Bitcoin spot was approved, Fidelity's, put out all kinds of positive news on it. Larry Fink's running around doing Bitcoin roadshows, which feels like an alternate universe. Some sort of Mandela effect shift happened 6 months ago. But what we are looking at now is an environment where Bitcoin is being viewed as positive, potentially a new asset class on Wall Street. So we think you're going to see it being added to asset allocation portfolios over the next 3 years, maybe at 1%, 2%, 3%, just initially in more aggressive portfolios. And then it's going to work its way into pension plans, maybe 5 to 10 years out. And if you start getting 1 to 3% in these big pension plans, and ultimately, on the high side, we'd see 5%. That's a big number, right? On a $100 trillion market, 5% is $5 trillion. And right now, Bitcoin's under $1 trillion in market cap. So that's a big impact.
Yeah. I think people maybe really haven't understood. You have to be a fair way down the Bitcoin rabbit hole to start to understand how Bitcoin is provably and absolutely finite. And it's fair to say at this point, I think Bitcoin the Bitcoin ETFs would be the only ETFs where the underlying thing that you could buy has a totally capped amount. Like with gold, gold is rare, but as the price rises, they're always making or finding new gold, and we have no way of knowing how much gold there is to be mined. But with Bitcoin, theoretically, there is an infinite amount of money that could find its way into these ETFs, and provably there is just factually only so much Bitcoin out there to be bought. So there hasn't been a dynamic like this on a Wall Street product ever. Is that fair to say?
That's really fair to say. That's a great point. Rocks and shells and gold and silver, there's always discoveries of new sources. And fiat, they just turn on a printing press and you can create new fiat. They created $10 trillion worth of new fiat just in the last couple of years. So the fact that Bitcoin is static at 21 million is super exciting. Clearly one of the key features of Bitcoin. And as you said, as demand widens, there's potentially, I don't know if you can say infinite, but you could say the entire financial ecosystem of let's just say Earth, putting its money into a capped 21 million coin market. And that is super exciting. And this could get pretty wild. In the end, people will buy the ETFs because of the performance. They're starting out because of curiosity. And obviously Bitcoin did 157% last year. So it's people are looking at it, realizing it over the last 10 years, Bitcoin has returned 50% a year annualized. And most asset classes on Wall Street are, 2, 3, 4, 5%, with the S&P 500 at the top end, somewhere around 9, 10, 11, 12%, depending on the time period you're looking at. In real estate, a little above that, real estate ETFs. smidgen above that, but nobody's seeing 50% annualized return. So the new kid on the block is the highest risk return asset to hit Wall Street in my memory. I've been doing this 30 years. So the excitement's there. But as you suggest, as performance will take over a year or two from now, people are going to be looking at these ETFs. And I think it is a performance-driven market, and as the performance is achieved by these ETFs, the demand is just going to go through the roof. And you've got $100 trillion minimum, on Wall Street waiting to do something.
Yeah, I mean, for people who are sort of looking at fund catalogs, what people tend to do as they're scanning is look at the 1 year, the 3 year, the 5 year, the 10 year. And just Bitcoin on its own, kind of maybe take the 1 year out, like you mentioned. On shorter time frames, the volatility is a lot for people to stomach, but on longer time frames, so far, the performance has been really in a class of its own. Be really interesting to see how that plays out. You mentioned something there, just a concept, and we talked about this with episode 10 with Newt Swanholm. And if you're interested to go back and check that episode out, if you didn't listen to it, Newt's concept is everything divided by 21 million. And it's kind of the idea that eventually this thing, the more momentum and a price appreciation it achieves, the more people it's going to attract. And this is sort of a positive feedback loop that ultimately results in Bitcoin kind of having a gravity that allows it to swallow sort of every other financial asset that exists. So that's called Hyperbitcoinization. And Newt and I had a really cool conversation about that back in November. Let's change gears, Mike. I want to talk about what you guys are doing is something super cool with one fund, CYBER HORNET ETFs. Tell me about it.
So we became Bitcoiners a few years ago and got so excited about jumping into, Lightning and Liquid and Blockstream and setting up our nodes and leaving Wall Street and just jumping in with a new decentralized financial superstructure that's starting to get implemented. But we saw that our knowledge of Wall Street could help. And so before we left, we decided, how can we bridge Wall Street to Bitcoin? How can we get 10 million Bitcoiners before legislation starts to restrict our ownership? Because, in our opinion, the people who control wealth, they don't mind if the minions have benefit from different asset classes, but they don't really want them to own them. To give you an example of that, owning land as opposed to just experiencing the returns of property. And with Bitcoin, you can see how they don't want to restrict your ability to own it because or to invest in it because people would be like, wait, this is a free country. At the same time, they really are uncomfortable, I think, with everybody having their own private keys and cold storage ownership of Bitcoin. And I think the reason ETFs were finally approved had something to do with that, because they realized that the BlackRock and Fidelity would hold all the keys. And I think there's clauses in all the prospectus that allow for, the government, they're government regulated, right? So if the government wants to shut them down, they can do it in a blink of an eye. Whereas if everyone had Bitcoin cold storage, what was your question again, Scott? Okay, yeah. So what we realized, we went out and got the CYBER HORNET name because that pinned tweet by Michael Saylor 3 years ago has really kind of stuck to the Bitcoin community. So you have the CYBER HORNET community, you have the Bogleheads being the S&P 500 zealots on the market who have, realized that the S&P 500 strategy outperforms most brokers. So we're there. And so we really saw an opportunity to unite the Bogleheads with the CYBER HORNET community, Bitcoin community. Went out and got that. We filed the trademark for CYBER HORNETs and really wanted to put out a suite of ETFs that helped investors capture the whole run-up of Bitcoin. Because we think as great as spot ETFs are for Bitcoin, in the end, people are going to buy in. Traditional investors will buy in. It'll run up. They'll buy some more. And then the first time it falls 50%, we think, it's just going to scare a lot of traditional investors out. they'll sell out, and then Bitcoin will continue its epic run up, and they'll miss it. They might hit some highs, get some, sell out at some lows. That seems to be the buy high and sell low seems to be par for a lot of investors that kind of get sucked in and out of the markets, because fear and greed is a tough enemy to fight when you invest, and especially in a real volatile asset. So our goal was, how can we buffer the downside volatility of Bitcoin so that investors can hodl, right? I think hodl, hold on for dear life. I think as Bitcoiners, we can hodl because we're religious about this, right? But a traditional investor down 50% is going to sell. A Bitcoiner, not so much. But I would guess, even if you talk to hardcore Bitcoiners, they've been selling at lows too and getting sucked back in at highs because they sold out when they got scared. If they're honest with you, they'll let you know that even they're struggling with that. So the idea behind the CYBER Hornets is we have a suite of 4 ETFs we want to bring to market. We just brought our first one to market a couple of weeks ago. That one was a 75-25 model. So 75% S&P 500, 25% Bitcoin futures. And then we rebalance monthly. So the idea is, and then we want to come out with a 50, or one of our new ones would be a 50-50, a 60-40, and a 40-60. So we're able to get some kick-ass ticker symbols reserved with the Nasdaq. And our first one came out at ZZZZZ, kind of taking that off from the Qs that are on the market. Qs next to SPY. QQQ is one of the most talked about ETFs on the market. It's the Nasdaq 100. But the traders call them the Qs. So we've got a suite of 4 3-letter tickers reserved at the Nasdaq for our ETFs. And there'll all be different percentage weightings of Bitcoin futures. And then now that spot's been approved, we're going to update our prospectus to allow for spot and futures to be held in our ETFs, and at our discretion of which of the two we'll use based on which one is the safest for our investors. And we can walk through some of the determinants of that in a minute. But as a Bitcoiner, we wanted to go straight to spot as soon as it was approved. But I can tell you, as we've started to look at the custody issues, we're starting to recognize some of the benefits of the Bitcoin futures. And so we're not just going to automatically switch everything over to spot, but we'll adjust our prospectus to allow for it at the discretion of the manager. And then we'll make that determination here in the next couple of months, how we're going to allocate the portfolios in the right way for our shareholders. But the basic concept is that we're introducing the new kid on the block, the highest risk return asset class to hit Wall Street in recent memory, with the old kid in the block, the king, the S&P 500 index, the most widely held index strategy on Wall Street, and has a proven process and a proven returns that are much less volatile than Bitcoin. And by the way, we're holding all 500 underlying stocks. So you have that bedrock of 75% of the portfolio in those 500 companies. And then the 25% in Bitcoin futures, we rebalance on a monthly basis. So if the S&P 500 during the month moves up relative to Bitcoin, we sell S&P high, buy Bitcoin low. If Bitcoin runs that month relative to the S&P 500, we sell Bitcoin high, buy S&P low, and bring it back to whatever the ratio of that ETF is. And right now, our first one is 75-20.
So an investor can come to you guys for sort of a one-stop shop and get this idea of they're getting all of the top performing companies in the United States, and they're getting an exposure to Bitcoin, and they don't have to think about constantly rebalancing the mix. So it's a super cool idea. Maybe just let's talk a little bit more about this idea of sort of is it right to call it volatility suppression? Or you're leveraging on the historical performance of the S&P 500 to help people sort of put their toe in and benefit from the upside of Bitcoin?
Yeah, that's a good way to look at it. And our competitive advantage is we're doing it with the S&P 500 index. Most asset managers wouldn't respond that way. And the reason is, if you have a high volatility investment like a Bitcoin that's doing this, then the way you buffer its downside vol is you bring in a non-vol asset class like treasuries would be non-vol. And so we think most of the models that you're going to see hit the market to protect the volatility of Bitcoin are going to be treasury based or long short strategies. They'll do some call put option strategies to buffer the volatility of Bitcoin. We're using the S&P 500, which is really a not traditional thing to use a vol asset like Standard & Poor's 500, which can be up 20%, down 20%, or even more any given year. So traditionally, that's not a non-vol asset class to combine with Bitcoin. But compared to Bitcoin, the S&P 500 is low vol. And we believe it's the most trusted brand name in the market. And so for the $7 trillion of investors that are already invested in the S&P 500, but are certain percentage are going to be Bitcoin curious, they already own the S&P 500 index. So they could either go out and buy it. Let's say they have $100,000 in their portfolio at S&P 500, and they're like, hey, I want to buy some Bitcoin. I'll buy $25,000. But that's going to go potentially through the moon on the upside, or all the way down, depending on, a negative outcome of Bitcoin. And so by bringing it into one portfolio strategy and combining it and doing the rebalancing, we can go to a financial advisor and say, by limiting the exposure to Bitcoin to 25% in this portfolio, if the worst case scenario happened for Bitcoin, you have a limited downside on this portfolio. Whereas if it does go to $1 million or more and the Bitcoin bulls are right, that same advisor can go to his clients and say, hey, I exposed you to the performance of Bitcoin in a very smart way, and we got these accelerated returns because of it. And they're going to be very happy. His clients are likely going to be very happy. But it likely wouldn't turn to a lawsuit if the Bitcoin portion of that portfolio went to zero for some reason, as opposed to if you had 100% of the portfolio in that side. And we, as Bitcoiners, we don't see that as a possibility. But you have to account for that. And if you're a fiduciary on investment portfolios, you have to account for the fact that any investment you can put a client in could potentially go to zero. Tesla could go to zero. Microsoft could go to zero. Technically, they can't. Most advisors don't think they will, but technically they can. And so the risk of them going to zero is what these innovative strategies, Bitcoin ETF strategies, are all about. And so for us, we're protecting or buffering or smoothing out the downside volatility of Bitcoin with the S&P 500. And frankly, as the S&P 500 is gaining, as Bitcoin goes through a bull cycle, the Bitcoin ecosystem on Wall Street will expand, and we're hoping to get a percentage of that. So we'll sell the gain. Conversely, when Bitcoin's going through a bear cycle, we can sell the pain, because this is why we don't think most investors can handle 100% of the upside or downside of Bitcoin, is because it is so volatile. So when Bitcoin does make those sharp pullbacks, we think our strategy will stand out for investors who can't handle that type of volatility. And that's a wider audience, right? Because maybe 30% of people can handle, massive volatility in their portfolios because they don't look at them, or they have diamond hands. But on the other hand, the 70% that kind of look at it and they get nervous when they're down 20%, we think they're going to get really nervous when they're down 50%. And you remember, when you're down 50% in Bitcoin and a bunch of articles are coming out saying Bitcoin sucks, here's why Bitcoin can get hacked, here's possible scenarios how it can go to zero. You're down 50% as an investor, and you get scared. And that happens, you sell out, and all of a sudden Bitcoin's back up. They're writing positive articles now, everything's rosy, and you're going, dang, I sold. And that's just life. So we're trying to figure out a way, create innovative strategies that are simple and familiar to traditional investors on Wall Street to allow them to hold Bitcoin over what we think will be an epic run over the next decade.
It is super innovative, and I love what you guys are doing. I while you were talking there, I queued up this Michael Saylor tweet that you mentioned, and he says, "Bitcoin is a swarm of cyber hornets serving the goddess of wisdom, feeding on the fire of truth, exponentially growing, ever smarter, faster, and stronger behind a wall of encrypted energy." I'm an unabashed Michael Saylor bro. We talk about him a lot on the show. One of the ideas actually that I think is worth mentioning here is Michael Saylor's talked about the idea that forget about CPI or the rate of inflation. What people should really care about is the expansion of the money supply. And so in the US, it's actually sort of around 7% historically. And so Saylor has this idea that the S&P 500 is the way to protect yourself against inflation because historically it has actually outperformed the base rate of expansion of the money supply. And in Canada, it's even worse. Most people, I was shocked to find out myself, the average expansion of M2 in Canada, average over the last 40 years is 8.5%. Canadian monetary supply expands by 8.5% per year. So you do need high performing assets just to stay in front of how fast your money is being debased. You guys got to be at Nasdaq before the end of the year. You closed the day, right?
Yeah, we got to ring the bell last Friday. Super exciting. I'll tell you what, they have a 10-story right in Times Square, a 10-story building that has that's fully lighted on the outside, so they can advertise and sell advertising on it. And we know those ads during peak times, hundreds of thousands of dollars just for seconds up there, depending on when. And Friday might not have been one of those peak hours, but we still were only expecting maybe being up on that tower for maybe 15, 30 seconds, maybe 60 seconds, if Nasdaq was being generous. But they rolled out the red carpet for CYBER HORNET ETFs, and we got up on their tower for over an hour, and they were uploading pictures of the whole ceremony, and just kind of looped it up there. I think, initially when we heard we got the close, because I was thinking we'd get the open, I'm like, the close. But it actually turned out better because when you get the opening ring, they'll show you ring, but then, all the news starts happening, right? And so they cut away. But at the close, everyone's going home. So we literally were on Times Square in front of everyone for an hour plus. And it was super exciting. They just treated us right. We're definitely going to use the Nasdaq the next time we IPO our next 3 ETFs. And so exciting, really exciting. And a lifetime goal of mine was to ring the bell at the New York Stock Exchange. But super happy to have selected the Nasdaq for this listing. We went through a review process and decided the Nasdaq was more tech focused. It was more retail focused. It's on Times Square, not downtown Wall Street, which is kind of synonymous with insiders. And so we chose the Nasdaq and are super happy we did. And it really went way beyond what we thought they were going to do for us.
That's so cool. So the first fund is out. It is ZZZ. Mike, if people want to find you online or find more out about Cyber Hornets and one fund, where can they find it?
CyberHornetETFs.com, and we own every, you can drop the S, add S's in there, and it still all goes to the same place. But we've got the Bitcoin community, and we're joining up. We're trying to get the Bogleheads excited about the Bitcoin community and the Cyber Hornets. And those two communities together, we think, make a good pact. And, Bitcoiners may look at us as diversifying too much, with the S&P 500. Why aren't you just selling Bitcoin? And why the heck are you using Bitcoin futures or ETFs that are held by custodians, hold your keys? So from a purist model, a Bitcoiner is initially going to be adverse to what we're doing. But rest assured, we are Bitcoiners, but we see the benefit of connecting. The way you connect Wall Street to Bitcoin is you got to provide that first step in a very simple and familiar way, and that's what we're doing with the ETF structure and bringing the S&P 500 into the mix. Combining these two giants, into one ETF strategy is just exciting to us, and using the Nasdaq to get there as our exchange, super exciting. And so now we've got our first product on the market. So we'll start to market that coming up here. We haven't done any marketing on it quite yet, but the concept is, to be able to own or invest in Bitcoin-like returns and still sleep at night, catch your Z's. That was kind of the idea behind ZZZ.
I'm excited to watch the rest of these come out and see what happens for you guys this year and in the years coming. Mike, thanks so much for coming on.
Thank you, Scott. Appreciate it. Talk next time.
Thanks for listening to this episode of the Block Reward. We're trying to do something different here, creating accessible conversations meant for people who aren't obsessed with Bitcoin. If you found this episode informative and engaging, hit that subscribe button to make sure you stay updated with future episodes. Your feedback matters. We'd greatly appreciate it if you could take a moment to share your reviews and help us with our goal of creating Bitcoin content that is simple and easy to understand. Bitcoin has an important role to play in the future of finance. It will change the way we save, spend, and invest. Discover why Bitcoin offers a game-changing opportunity for forward-thinking employers by visiting Blockrewards.ca. Blockrewards' mission is helping Canadian employers implement strategies for integrating Bitcoin into compensation and benefits, supercharge your recruitment and retention strategies, and help your team members plan for the rising cost of living by rewarding their work with the hardest money ever invented. Special thanks to our top sponsor, Paramount Employee Benefits Consulting, Canada's only Bitcoin forward benefits and pension advisory. For more information, find them at paramountbenefits.ca. Big shout out to Podigy, our production team that makes all this possible, and BMX Escape for producing our music. Bitcoin is an expansive and dense topic many people walk away from early. To Bitcoin enthusiasts looking for that podcast they can share with friends, family, and colleagues, one they'll actually listen to, we hope that is us. The content of these conversations is meant to be provided for information purposes only. Nothing here is investment advice. Bitcoin is a big topic. Be sure to do your own research before making any personal financial decisions. Thanks for listening.